Hello, everyone. Welcome to another Adam Live video. And on today's video, we're going to be talking about cryptos, IRAs, and can you hold your own keys? So this is a super hot topic, obviously, with the current events surrounding the cryptocurrency marketplace over the last 3 or 4 months with various crypto exchanges from Voyager, Celsius, BlockFi, and now FTX essentially declaring bankruptcy, or at least on the verge of bankruptcy. So I wanted to do this video. I've done a lot of blogs and podcasts and videos about holding cryptos on a private, at least the private keys on a cold wallet. It's almost a year to the date of the McNulty v. Commissioner case, which came out November 18th, 2021. Hard to believe it's a year. So I wanted to go through that case and then kind of look back at that case and now look at where we are today in the crypto market and really look at whether holding cryptos in a cold wallet, how that could potentially impact the prohibited transaction rules and the lessons from the McNulty case. So I wanted to revisit that. I think things have changed. I think the cryptocurrency market now, from a security standpoint, there's certainly a real need to look at potentially holding the coins on a cold wallet off an exchange. Okay, so what I want to do is just kind of start from the beginning, talk about how the IRS views cryptocurrency, look at the prohibited transaction rules too, and then ultimately go into the McNulty case, and then talk about some of the similarities and differences between metals, coins, and what it all means. So let me just preface this. This is not legal advice. I am a tax lawyer, obviously founder of IRA Financial. This is my thoughts. So there's certainly a lot of gray in this area, thanks to the McNulty case, in terms of whether you can hold cryptos in a cold wallet, the private key. And I just wanted to obviously add more depth to the conversation. Not sure we're going to see much more from the IRS anytime soon. I mean, it took them 2014 is when they issued their notice on the taxation of cryptos. We haven't heard much since. The DOL has been a little bit more active in terms of cautioning 401ks to invest in cryptos. But in terms of holding them and private keys and prohibited transactions, we haven't seen anything since 2014. So not sure how quick the IRS is going to turn around. I think regulators, whether it's the CFTC, on the commodity side, the SEC, state regulators, they are definitely going to be looking at exchanges security-wise. They're not going to be focusing on prohibited transactions and IRAs. So that's not something that they're going to be addressing. So let's start at the beginning. Why don't we do that? So cryptocurrencies, I'm not going to go into much detail. Everyone knows what a crypto is if you're watching this video, whether it's Bitcoin, Ethereum, or some altcoins. It's based off blockchain technology, and it's hopefully a new way to transact from a financial perspective that has more privacy and more flexibility, but also more security risk, which we've seen over the last year. So there's different ways to hold cryptocurrency. Obviously, most people hold it on a exchange like Coinbase or Gemini or Kraken or Binance. Now, exchanges have come under fire in the last 3-4 months, as I mentioned, with Voyager, BlockFi, Celsius, and now FTX, which was the second largest exchange in the world, which declared bankruptcy. But of what's of note is that none of these exchanges had actually New York bit licenses. BlockFi basically was just a lending company, same with Celsius. Voyager pretty much as well. FTX was registered in the Bahamas. They had FTX USA, but it did not have, at least I don't think it had a New York bit licenses. So my point is that the U.S. crypto exchanges are more secure than the foreign exchanges, even a Binance, which is the largest exchange in the world. You don't even know where their headquarters is. And I mentioned this on previous videos. Like, if you need to send them notification or anything, you have to send it to an info box. There's no phone numbers. You don't even know if they're in Singapore or Hong Kong or where the heck they are. Okay, so that's troublesome in itself. But again, it's the largest exchange in the world. So prior to 2022, people did have concerns about exchanges. Mostly it was from social engineering and fraud, hacking, someone hacking on your phone and stealing your Bitcoin. There was less of a concern about systematic failures on the part of an exchange, especially the U.S. exchanges that are regulated by various states. No federal regulation in terms of SEC or CFTC, but state regulation. And I think the larger U.S.-based exchanges have, claimed at least that they have one-on-one reserves. They've are allowing withdrawals on cryptos, so that's comforting. But there are certainly a large group of investors, IRA, non-IRA, that said, "Hey, I need an exchange to trade. I got that. But if I'm going to hodl and just kind of hold my cryptos, then I want to be able to do it maybe in a different way. Maybe I want to be able to hold it personally in a cold wallet off the internet, so I can't get socially engineered, can't get hacked, and my cryptos hopefully will be more secure. Whether I put that in a vault or in a bank safe deposit box or wherever, there is a real security need to do so. And obviously, starting with BlockFi and Voyager and Celsius and the 3 Hour hedge fund collapse, more and more investors have said, hey, this is not something that I necessarily want to do, but I kind of need to do this now. I need to take matters into my own hands because cryptos are permitted to be invested by retirement accounts. They're treated as property as per the IRS, just like real estate or stocks. So I know I can buy it. The DOL did issue guidance on 401k saying, hey, it may not be the best investment for your 401k, but it certainly did not prohibit it. So IRA investors have certainly looked to take advantage of the ability to invest in cryptos, even though there is great risk. The volatility, we saw Bitcoin's down, over 70% this year. So yes, people point out that so is Netflix, and so is various other Tesla and various other Facebook, other equities, but it's certainly a volatile asset. And now when you add the fact that these exchanges may have security risks or may have fraud and a lack of procedures in place, that's scary. So there's been a movement to try to pull these cryptos to a cold wallet. What's a cold wallet? It's like a Ledger Nano, right? Think of it like a USB. Something you hold where you can pull the cryptos off the exchange into a USB that you can pull off the internet, kind of tuck away somewhere safe. And the advantage of that is it's off the internet, so far less chance of someone hacking into it. Or if an exchange, God forbid, goes under, there's zero risk because your cryptos are off the exchange. Now, one thing to remember about buying cryptocurrency is that when you purchase cryptocurrency on an exchange, the crypto you buy is on the blockchain. So when you buy a Bitcoin, it has a public address. Okay, so it's on a blockchain, whether it's the Ethereum blockchain or the Bitcoin blockchain or whatever blockchain associated with that crypto. So there's a public key. Everyone could see that address. Okay, the private key is obviously only known to the holder of the true Bitcoin. And that's something that is the core of cryptocurrency. It's like keys to your house, keys to your car, keys to your safe. Whoever has the keys has the power to open that instrument, whether it's the car, the safe, or the door to your front, to your house. So the public keys are important, right? That's how you know where to send cryptos, right? If I want to send it to a friend, I need to know their public address. The private key is super important, which is connected to the public key because only I have that private key, that code. So only I could type it in to get access to that Bitcoin. So before 2022, I would say, before summer 2022, when all this stuff started happening in the crypto market, a lot of investors believed that when you bought cryptos on an exchange, that you had the private key. You controlled it, right? Like I own Tesla stock, I own Apple stock. Those are my shares. They're registered into my name. They're mine. I can grab them anytime I want. Unfortunately, the way it works, and it's not just one exchange, it's all exchanges, is that when you hold cryptos on an exchange, the exchange holds your private key. Now, you expect most crypto exchanges to have one-to-one, meaning if you have Bitcoin, they have your Bitcoin. It may not be in your name, but it's a one-to-one reserve. Meaning if they have 100 people that bought Bitcoin, those 100 Bitcoins are available in the exchange. So if someone needs to liquidate or if all want to withdraw at the same time, the exchange has all 100 Bitcoins. It turned out, thanks to FTX and some of these other exchanges, that wasn't necessarily the case. Those cryptos didn't necessarily relate one-to-one with their owners. So if you bought Bitcoin on an exchange, you didn't own the private key, whether it's Robinhood, whether it's Coinbase or Kraken, Binance, and the exchange holds the private key. Now, they are the custodian of that private key, steward. They're supposed to hold those private keys safe for you, but we know what happened thanks to FTX, and that's not the case. So the only way to truly know that you have control over those cryptos is to own the private key. And the only way to really do that, 100% clarity, is to hold those cryptos on a wallet that you control, whether it's a hot or cold wallet. Hot wallet is just an online type wallet. It still could be super secure. Or a cold wallet like a Ledger Nano or somewhere that you control it. It's off the internet and you have that private key. So before McNulty, before November 21, there was wide consensus in the IRA industry, including myself, that holding the private key to a crypto off an exchange seemingly didn't violate any IRS guidance or any provision of the tax code. The only provision in the tax code that talks about possession of an IRA asset is in section 408M, as in Michael, and it talks about possession of precious metals or coins, American Eagles. And under 408M, it's clear that if you hold metals or coins, they must be in the physical possession of a U.S. trustee, which is basically a U.S. bank, U.S. financial institution, or U.S. trust company, like a depository. Depositories are U.S. trust companies. So that was really the only provision that spoke to possession. Okay, why? Because most assets you buy in an IRA, like real estate, it's not something you can touch in your hand. Yeah, we can go see the house we own or the piece of land we own, but that's not something you can put in your pocket or put in a safe. Okay, so metals and coins were kind of unique. They were a tangible asset. Collectibles cannot be purchased in an IRA, but metals was the only exception to that collectible rule and an asset that you can touch. So before McNulty, the position was, okay, if it's not as long as you hold metals physically at a depository, you're good. And since all other assets aren't addressed by section 408M, including cryptos, we're not going to really focus on possession because it seemingly doesn't apply to other assets. McNulty v. Commissioner, the opinion letter comes out November 18th, so almost a year to the day, 2021. This was a case of a self-directed IRA LLC client, the McNultys, that owned real estate, but also metals, coins, and gold in their LLC. And they decided to hold those metals and coins in their LLC, in their home, in a safe, or not in a physical possession of a depository or U.S. financial institution. So clearly that violated 408M. Slam dunk case. I don't even know why they fought it. They should have just kind of folded up and said, sorry, IRS, here's our tax money. Sorry, we're moving on. They decided to fight it. I don't know why. And they lost. But they didn't just lose. What happened is that the tax court wrote a very, very broad opinion. And in summary, this opinion essentially didn't just focus on metals, but it focused on IRA assets. And if I can summarize the opinion letter in a sentence or so, it basically said as follows. If your retirement account owns assets, you cannot have unfettered control or unfettered command or possession of those assets. And they made that statement super broad. So it seemingly didn't just apply to metals and coins. The opinion could have just said, hey, the McNulty's violated Section 408M. They held these metals or coins personally, not in the physical possession of a bank or trustee. Therefore, they violated 408M, and we have to rule against them. That's the way I would have, wrote my opinion letter. Probably could have done it in 5 pages. But they ended up making a very, very broad and bold statement and seemingly expanded the concept of physical possession and unfettered control to not just metals, but to all IRA assets. For most IRA assets, it's not an issue, right? If your IRA owns real estate or a note or a private placement, stocks, you're not holding, you don't have possession of that underlying asset. You might have possession of a copy of the deed. You may have brokerage statements or a copy of the note, but you don't have possession of the underlying asset. Cryptos is unique, right? It's not tangible. You can't touch it per se, but if it's in a wallet, a cold wallet like a Nano, pretend this is my Nano, I can hold it. And if I hold it, technically I could then transfer it. So I seemingly do have unfettered command or control over that asset, whereas a deed, I may have the deed in my hand, but I don't have the real estate in my pocket. So that's the difficulty of McNulty and cryptos. Cryptos is a new asset class, right? Bitcoin was created 12 years ago. So we don't have a lot of guidance on how it's treated. We know what it is. We know the technology behind it. We understand blockchain. We understand there is a security need right now to hold cryptos in a cold wallet. So we have our private keys in light of FTX and some of these other exchanges. But how does that coincide with McNulty? Well, no one knows. Okay, and that's why I'm going to preface what I'm about to say with, this is just my thoughts, not legal advice. I'm not telling people pull off your cryptos off an exchange and hold them in a cold wallet. With personal assets, that's your choice. You don't have any risk of violating McNulty or prohibited transactions with your personal assets. That's up to you. No keys, no cheese. If you want to pull your personal cryptos off an exchange and hold them personally in a cold wallet, God bless you. It's your right. The IRAs, we have to deal with certain prohibited transaction rules under 408, 4975. The problem is we don't have a set of rules that we can play by. All we have is 408M that talks about physical possession and metals. And we have McNulty that seems to offer a very broad statement talking about possession, unfettered control over IRA assets. It did not mention the word cryptocurrency once. It is not a cryptocurrency case. It's a case on metals. The statements in McNulty are very broad, so potentially it could apply to cryptos, but it doesn't. Now, here's a few wrinkles to add some layers to this discussion. We know that when you buy Bitcoin or Ethereum, the Bitcoin or Ethereum goes on a blockchain. So your address, your public key, your address is on a blockchain. So that means if the IRS wanted to verify where your cryptos are, they technically can on your blockchain, right? If you provided them your public keys, your public address, they can follow and see if you transferred that Bitcoin or that Ethereum or that other altcoin somewhere else, just by following blockchain. So if you compare that to metals, which doesn't have a blockchain, which if you hold them in your home, you obviously can sell them to your neighbor or do whatever you want with them. The IRS has a lot more security and a lot more oversight with cryptos and blockchain than they would with gold. So that's, I think, a supporting argument to say that, hey, if you do hold your cryptos in a private cold wallet, at least the keys in a cold wallet, it's not, you do potentially have control, but the IRS does have better oversight than they would with metals because blockchain. Blockchain will show them where the crypto is and will trace if it was ever transferred. Now, they may not know who it was transferred to, right? Because it is anonymous. It just has a public address, but they can ask you that question. And as a taxpayer, the onus will fall on you to prove or disprove to the IRS where those assets are. So blockchain is a very, I think, important supporting fact for potentially holding cryptos on a cold wallet because the IRS has a lot more oversight and scrutiny potential than they do with metals. You may compare it to a deed, right? You can hold a deed or a promissory note in your possession, okay? Just like you should be able to hold the nano with the Bitcoin in your possession. You can sell the note or you can sell the real estate just like you can sell the cryptos. The difference is, obviously, from a transaction standpoint, there's a lot more information on selling real estate than selling cryptos. But that's not the point. The point goes to unfettered control. And do you have unfettered control if you hold the cryptocurrency in a Ledger Nano in your pocket? It's hard to say no, right? Because from there, you can transfer it to your friend, yourself. You can transfer it to a DeFi exchange. You do have control since you own the private keys. I can't deny that, okay? You may compare it to a deed or a note and say, hey, if I have a deed, I can transfer the real estate to anyone I want. That's true, right? The only difference is that with an IRA, there's more of a greater likelihood that the money goes back to the IRA than if you owned cryptos in a private, in a cold wallet, that crypto will go back onto the exchange that your IRA owns, right? There's no guarantee. You can transfer it to a third party and you can exchange it for cryptos and you can stay there. You would hope that you would have to get back on the exchange to get fiat US dollars, but maybe you can go and commingle it with personal funds and then push it off to another exchange where you have a personal account. I understand the scrutiny. I understand the IRS position, right? I do. The IRS is like, hey, this is for your retirement account. We have these rules in place about prohibited transactions. We want to make sure you're making investments for specific IRA purposes, not to personally benefit yourself. So we need to have some controls, some rules, and some limitations that you can't just take the cryptos and exchange it and then put it onto an exchange in a personal wallet and then use it to buy a car or buy a house. We need to have some guardrails. And I understand that. But blockchain will solve that problem, because blockchain, you'll be able to follow the crypto. And then you can ask the taxpayer, hey, Joe, hey, Jane, I see you made 2 transfers on June 15th, on January 8th. Prove to me who those transfers went to. And if you say, well, I moved them to this exchange or that exchange, here's my IRA wallet, I think you're good. If you can't and say, oh, no, I transferred them to myself, then it's easy for the IRS to attack you. So personally, I think there's a good argument. Again, I don't know how the IRS would react and how a tax court would opine, but I think based off the security risks involved now with crypto exchanges, the safety and precautions people want to take in holding private keys on a cold wallet, the fact that you can buy IRAs in a retirement account, thanks to the Notice 2014-21, putting all that together and then adding the layer of protection of blockchain, which provides transparency, allows the IRS to follow a chain and make sure that these coins, these crypto coins, were in fact transferred to your IRA account and not to yourself or to a kid or to a parent. I think that should be enough guardrails that the IRS should understand the risks involved with some exchanges and say, okay, we'll let you hold these cryptos off to a private wallet. Maybe we'll force you to put it in a depository. Maybe we'll force you to have a non-disqualified person hold a key. But they should have comfort in the fact that blockchain will provide them all the information and details they need to prove, if they audit someone, that those cryptocurrencies did not end up in any disqualified person's hand, i.e. a parent, child, spouse, daughter-in-law, son-in-law, or any yourself or any entities controlled by such persons. So McNulty, before McNulty, I think there was a lot of support for saying, yeah, you can pull these cryptos off an exchange. Unfortunately, after McNulty last year, there's less guidance. It's more gray. I still think there's strong support because of blockchain, giving that the IRS extra scrutiny, transparency, and oversight, the ability to make sure these cryptos can at least be traced, and then the taxpayer would have the burden of proof to show they didn't end up in anyone disqualified person's hands. But again, at this point, it's just unknown. So I can't give you a direct answer. I can't say do it. You're not going to have any IRS risk, or don't do it. I don't know. I think that's up to you to make that decision. I don't think any lawyer, any tax lawyer can tell you definitively one way or the other. I think there's a lot of gray. I think there's a security position that doesn't exist for metals. I think blockchain adds, again, another layer of transparency that doesn't exist for other assets. It looks a lot more like real estate than metals. Metals, I can transfer to anyone I want. There's no trace. With a deed, I can't. I have to, publicly disclose and redeed that title. Just like with blockchain, if I transfer my Bitcoin somewhere, it's on the blockchain. Okay, so someone can trace it and then prove, and then ask me, the taxpayer, say, Adam, I see you transfer the Bitcoin on this date. Who did it go to? And ultimately, that's potentially where it could go. But I don't know. Just for the record, and hopefully first quarter next year, we are going to be coming out with a multi-signature wallet option where you're going to be able to take your cryptos off an exchange, and then you'll have a key. We'll have a key, but you'll be able to move things with our consent. So this way, we'll have some custodian consent, but you'll be able to hold those cryptos in a cold wallet in a safe. But you'll need our consent to move it back to the exchange or transfer it, which isn't ideal. I wish I can give you ultimate freedom, but until we get more guidance from the IRS in terms of McNulty and where things stand, that may be the best option at this point. Let me get to some questions. How do you feel about international crypto exchanges? Personally, again, don't take this the wrong way. I would not hold cryptos in any non-US exchange. I would not hold cryptos in any exchange that doesn't have a New York BIT license. That's my personal opinion. I got spooked by FTX. Binance is the biggest exchange in the world, but I know, as I mentioned, I have a client that got socially engineered, hundreds of thousands of dollars. He hired a company. They've traced the wallet to Binance, Singapore or Hong Kong. They don't even know where it is. Binance is refusing to release the wallet. The FBI is involved, and they're refusing to even communicate. So what does that tell you about the exchange? They don't take security seriously. And yeah, a lot of people, you go on social media and Twitter, and there's a lot of crypto Bitcoin people talking about, forget about security. It's all about control and privacy. And if you get social engineering, tough luck. Like no exchanges should be regulated. Who cares? Well, it's easy to say when you're on the other side. Wait till you get hacked, you get social engineered, and now you know that wallet's on a foreign exchange, but you can't touch it. And it's your money's there, and you know it's your money because you can trace it to the hacker, but you can't touch it. That's painful. So I'm all for regulation. If cryptocurrency will make it, which I do believe it will, there needs to be regulation, either the SEC, CFTC, a new division. I don't care. But these exchanges need to be scrutinized. There needs to be oversight. There needs to be audits. And customers like you and me need to know that there's one-to-one reserves and our cryptocurrency is safe, whether it's via insurance or some other means. But we have to know that, because if not, we're not going to ever buy cryptos. There's no point. So you're saying that metals cannot be stored in my personal safe. That's correct. Metals, coins, under Section 408M needs to be held in physical possession of a depository. We work with some amazing depositories. So that's what I would do. For Ethereum, Bitcoin, we're working on obviously getting things handled for all our clients that are on Gemini, and we're focused and committed to making that happen as soon as possible. So there's not a day goes by that we're not focused on getting our clients cryptos back and working with Gemini to make sure that happens. So that's our number one goal and our commitment, and we're not going to stop until we can help all our clients. And that's why there's been a big push to try to get control over the private key, because people got spooked with FTX, they got spooked with Voyager and Celsius and BlockFi, and they just want more control. And I understand it. I totally understand it, and I'm hopeful the IRS would understand it as well, especially when they have blockchain providing them an extra layer of transparency. Multi-sig addresses, this trustee can monitor, but you can retain control. Will you allow multi-sigs once you move from Gemini? Yeah, that's our goal, Scott. We're going to have a multi-sig option. We're working on that right now, where you'll be able to move your cryptos off the exchange, hold it, but you will need our consent to move it somewhere else. I'm going to work on a way to make sure that consent's done, instantaneously. Good crypto wallets, Ledger Nano, there's a bunch. You can Google around, depending on if you have Bitcoin or Ethereum. There's different wallets for each crypto. Definitely do your research. The key is, to get a cold wallet and hold them off an exchange. I think that's the most secure versus a hot wallet that still could be susceptible to, hacking and social engineering. Obviously, holding on the exchange should be secure, right? No one pulls their stocks off an exchange. Yeah, there is some direct registration. I've seen it with GameStop and AMC, but for most shares with lots of liquidity and not a lot of short sellers, there's zero risk to having your shares at a brokerage firm like Vanguard, Fidelity. The same should be true for Bitcoin or Ethereum. We shouldn't have these risks. Now, maybe these exchanges grew too fast. Maybe regulators weren't ready for the growth in cryptocurrency in the last 2 years, but either way, things need to change, and regulators are not immune from attack. Okay, cryptocurrency exchanges also deserve blame, but regulators deserve blame as well. Whether it's New York or other states, they are in charge of these exchanges. They've seen, they can easily go on their website, they see what they're selling, they read social media, they read Twitter. They could have easily asked for more detailed audits, one-to-one reserves. This is all stuff they could have asked for, and they didn't. So this is not just about blaming one exchange or multiple exchanges. Regulators are part of the problem. Now, listen, a Bahama regulatory body, I don't think is as conducive to real regulation than US or New York. So that's why I would not hold cryptos on a foreign exchange. That's just me. I have a lot of clients and friends that do. I would not. I trust US regulators, especially New York bit licenses, but they should have done a better job policing all this stuff. Could they have stopped it? I don't know. They couldn't have stopped FTX, right? Because FTX was a Bahamian company. It was not a US company. Could not have stopped FTX. Could they have stopped Celsius, Voyager, BlockFi? Maybe. BlockFi did pay $100 million fine for its loan programs. Maybe they should have shut them down at that point, right? They did change rules and make them sell to accredited investors. But did they scrutinize these loans? Who are these cryptos lent off to? Or was there a scrutiny of their partners? Was there diligence on these hedge funds that got these loans? I don't know, right? I'm just saying there's a lot of blame to go around. But as an investor, I need to look out for myself. And if regulators aren't going to look out for me, I totally understand why investors want to hold their private key, especially in their retirement account. Especially most retirement account holders are hodlers, right? They're buying Bitcoin, Ethereum for the long run. So it's not about day trading. It's about, hey, I'm going to hold this stuff for the next 3, 5, 10, 15 years. Like me, I haven't sold any cryptos in my IRA. And for the record, I still hold all my IRA cryptos on exchange, for the record. So I'm still comfortable and confident in the U.S. exchanges that I work with. That's just me, but I totally understand if people are spooked based off what they've read over the last couple months. I totally get that. Yeah, Ledger is a good one. Only buy new, right? Good point, James. Yeah, buy a new one. Don't buy used Ledger, which could be compromised. That's kind of where I am. Am I storing in Gemini still? Yeah, my cryptos are at this point still on Gemini. Gemini is New York. They don't have a New York bit license. Obviously, they're not perfect, but I think ultimately, personally, just in my position, they've clearly stated they're one-to-one exchange. and we've had no issues. We've had clients pull money off them with zero issue. They have some exposure to their earn program with Genesis, but I think that's a different issue. So anyways, that's something we're working on as well. In terms of our new crypto platform, all the security we are working on, we're going to have a big announcement in first quarter. Bitstamp will be a new partner of ours, where we're going to be offering a safe, secure crypto platform for low fees, no asset valuation fees, and hopefully a multi-signature option very shortly, so people can either hold them off the exchange, or hold them on the exchange, or off, and feel safe, and then taking into account McNulty, not have to worry. So there's a lot to be said. Unfortunately, there's not a lot of IRA's guidance on holding cryptos personally in a cold wallet. I wish there was more. I don't expect more. I was in DC a few weeks ago in a conference. I spoke to the IRS about this. This is not even on the radar. The guy looked at me like I had four heads. He's like, "What are you talking about?" We're not even anywhere near worrying about this stuff. So I don't think we're going to see any guidance in, I would say, 3+ years. So the fact that the statute of limitations is only 3 years, take that for what it's worth. But I understand. I've talked to clients and said, Adam, I appreciate you can't give me an opinion, but I want my cryptos off an exchange. I'm going to do an IRA LLC. I'm going to buy cryptos and pull it off the exchange and hold it. And if I get audited, I will use the arguments of a blockchain. I'll have proof. I'll put it in a safe. I'll even give you a key to my brother or sister. I won't have a key. I'll do everything I need to show to prove that I haven't done anything bad with these cryptos from a disqualified person, prohibited transaction perspective. I have blockchain. The IRS can look at the chain to show I have not ever touched these cryptos. The 2 Bitcoin I bought 3 years ago are still here. Same 2 Bitcoin, same address. I think those are the facts that, unlike gold, that is playing positively in the hands of crypto investors who can show the IRS that they're audited. Look, here are my cryptos. Okay, here's the 2 Bitcoin I bought back in 2020. It's 2024 right now. Here's the same 2 Bitcoin with the same address on the same ledger. Leave me alone. I did it for protection. You should be happy that I have these cryptos, because maybe if they're on the exchange, the value would go down to zero. And then if I had to take requirement of distributions, my IRA would be worth zero instead of what it's worth today. So, so that's the issue right now. But otherwise, it's hopefully going to get better. There's obviously, you can see from these questions, people are super concerned about hacking, social engineering, the state of the crypto marketplace. And that's why I'm doing this video, right? It's to really say, okay, I'm a tax lawyer. I have a master's in tax law. I've been practicing tax law, give or take 20+ years. This is my area of focus, retirement accounts. I'm going to tell you what I think. This is not a legal opinion. This is just my personal thought. I still believe U.S. exchanges are safe. The ones with the bit licenses, not the quasi exchanges that piggyback off exchanges and say they're an exchange. I mean, the real exchanges. I do believe they're safe. The exchanges that say they're one-to-one, I do believe they're safe. But I understand when people say, hey, Adam, I got you, but this is my retirement account. I believe in cryptos, but I need to hold this stuff personally because I don't trust anything at this point. Now, what's the downside? It's the last thing I'm going to do. What happens if the IRS knocks on your door and says, hey, Adam, seems like you hold your cryptos personally. I'm watching your video. You're in trouble. And I say, okay, well, I disagree with you. And we go back and forth. And I say, here's my Bitcoin, my Ethereum. Here's the address. Here it's on the blockchain. I bought this 4 years ago, 5 years ago. Leave me alone. What can they do? Well, I mentioned there's a 3-year statute of limitation generally for attacking IRAs. So you have 3 years essentially where you're open game to IRS attack. After 3 years, much more difficult for the IRS to audit you. Now, there's no specific IRA division. There's no crypto IRA division. There's audit records for 401ks, not for IRAs. Okay, I've been doing IRA. I'm in the IRA world 13 years, almost going on 14 years. I've dealt with a handful of IRA audits. All of them have been folks over the age of 72. where the IRS just wanted to look at valuation. So yeah, there's risk. I can get audited, you can get audited, but it's generally a 3-year risk. What happens if you get audited? The IRS will basically deem your IRA violated on the date you moved it to a cold wallet, if they're saying that that's a prohibited transaction. Again, I do believe there's very strong support based off blockchain technology to show the IRS that this is different than metals. You can prove, I can prove, and you can verify where my cryptos are based off blockchain. And I can prove the addresses based off my wallet and the blockchain to show I didn't do anything, wonky with the cryptos or anything prohibited. So for that reason, I do think it's different than metals, but I don't know what the IRS will say in a week, 6 months, or 3 years. So that's why I'm saying worst case, you pay tax, and if you're under 59.5, potentially 10% penalty on the date you pull the cryptos off for doing the transaction. Over 3 years, it's going to be extremely hard for the IRS to attack you based off the 3-year statute of limitation. So that's where we're at. I appreciate all the comments. Definitely dislike the video. I'm not, a professional actor. So I'm doing the best I can. I'm a lawyer, trying to give everyone the best content I have. If people have comments on the presentation, give me a like or a not a like. Leave me a message. I actually go through all comments, and I will do my best to personally respond. So please do that. It's a great channel. You're on it, so I think you see the content. I work really hard on providing updated and accurate, for the most part. That's the most important part, content. I also drop 3 videos a week and 3 podcasts a week where you can pick up on Spotify, Apple, SoundCloud. You can also check it out on our YouTube channel. So if you haven't subscribed, leave a comment, like it, or don't. I learned from the dislikes too. Sometimes I get negative feedback, and that's cool. I'm like, okay, I'm learning from it. But when it comes to this, I wish I was able to give everyone more definitive guidance on how the IRS would see this or will see this. I don't. All I have is 408M. It talks about physical possession. I have McNulty. It talks about unfettered command of all IRS assets. And now we have cryptos, which is not a metal, which has very different characteristics than a metal, which has very different technology than metals, i.e. blockchain. And I think offers the IRS a far greater sense of oversight and scrutiny that does not exist in the metals case, and hopefully would lead the IRS to a different conclusion based off the McNulty opinion. So, thanks for everyone spending some time with me today. I know it's pre-Thanksgiving. I know it's a super important topic. I've been glued to social media really for the last couple months, really since the summer, since 3 Arrows. But it's been heartbreaking. The FTX debacle is heartbreaking. I have friends that lost money. I have friends that lost money in BlockFi and Voyager. I've had employees lose money on Celsius. This sucks. Okay, this should never have happened, and blame should be spread. And it's important to separate FTX, which is pure Bernie Madoff fraud theft, from some of the other exchanges like the Voyager, like Celsius and BlockFi, where it was just mismanagement, growing too fast and getting overly exposed to lending partners that weren't properly vetted and didn't have enough diversification. That is different. That's poor business decisions. That's far different than FTX, where FTX was just outright theft, outright fraud. That's criminal. And that that guy should SB. I don't even want to mention his name. He should go away for the rest of his life. What he did was criminal. The other stuff, oversight should be able to handle, make these businesses better regulated, better run, better diversified, more scrutiny, more diligence on their partners from an investment, and also from a security standpoint. That's also very important. So cryptos aren't going away. We're going to all learn from this. It's going to delay mass adoption quite a bit, but I'm still bullish on cryptocurrency, even though I've experienced just a really difficult situation for some of my clients, and continuing on for the rest of the cryptocurrency marketplace over the last several months. It's been hard to watch, but I'm optimistic that things will turn, things will get cleaned up, and the technology, which is the core, we can't lose track. This is a technology play. Technology is not going away. We really haven't even uncovered the true usage of cryptocurrency, whether it's Bitcoin, whether it's altcoins or NFTs and blockchain. And that, whether it's Web 3.0 or something else, I don't know. But I see my kids, they're still bullish on cryptos. They're still, if they have $100 to spend, they want to buy Doge or Bitcoin or Ethereum instead of Facebook or Tesla. That's true. I can tell you from talking to my kids and their friends. They're into the future. They're into NFTs. They're still buying NFTs. But the market's got to clean up. These crypto exchanges need to put on their big boy pants and own up, fix their mistakes, step up to the game, work with their customers, put a phone number on their website, protect customers from social engineering, hacking as best they can, and make sure they run their business like Fidelity and Vanguard and not like Bernie Madoff. And that's just the bottom line. So I will do my best to keep everyone updated. Again, I'm hopeful for the future, whether it's Gemini or the whole cryptocurrency marketplace. I'm hopeful that things are going to move in the right direction, and the worst is behind us. So pray. But I want to wish everyone a great Thanksgiving, happy holidays. Hope you get to spend time with your families. I think the cryptocurrency discussion at the Thanksgiving dinner table will be a lot different this year than last year. I remember talking to family and friends last year, and thought Bitcoin 100% would go to 70,000 last year. I didn't even think twice about it. So my family may not be super happy with me this year. I know they're not. But again, I'm a long-term player. I'm 47. I haven't sold any cryptos in my retirement account. I'm focused on where cryptos will be at 59.5, not at 47. I do understand that folks are older and they don't have a 15-year horizon. They maybe have a 1 to 3 year. And I only could pray that things turn around quick and the values go back up to where they were and go from there. So I hope you guys enjoyed the video. Again, it's not legal advice. I wish I can give more definitive guidance, but all we have is 408M and McNulty, and then we have to compare that to a new digital asset that's not tangible like metals, where you can personally possess it, but in a wallet form, which also has an extra level of blockchain technology as oversight to the IRS, which does not exist for metal. So thanks again for spending some time with me today. I really, really appreciate it. And subscribe, don't like, give me a comment, and send me a question too. I'm happy to answer anyone's information as best as I can. So appreciate it. Happy Thanksgiving, and take care.